All righty, welcome everyone, and thank you for joining us today. My name is Bella. I'm your host for today's webinar, our Mid-Year Economic Outlook. We're very excited to have LPL's Chief Equity Strategist, Dr. Quincy Krosby, on the call with us today. A few housekeeping items before I hand the spotlight over to Carrie and Quincy. Let me move this over so you can see here. Perfect. All right. The webinar is being recorded and will be made available on our website under the Resources tab, or also it will be posted on our YouTube channel. There are 2 poll questions. I can see a couple of you went ahead and answered them. Go ahead if you haven't already. Take a moment, answer those questions, and we'll address those towards the end of a webinar. Also, at the end of the webinar, we'll be having a Q&A session. So down next to that poll button as well is the Q&A button. Go ahead and type your questions in there, and we'll answer as many as we can with the time allotted. All right, we're all squared away. I will hand it over to Carrie.
All right, thank you, Bella. Thank you for that introduction, and thank you for attending our mid-year 2022 economic outlook. This time we're going to do it a little bit differently. In the past, we've had staff of KWB present and do a Q&A and whatnot. And while we have MBAs and other credentialed people, we didn't have a doctor. And so given the volatility of the markets, so far this year, okay, forget the volatility, let's just call it negativity. We thought maybe having a doctor aboard and helping us kind of maybe understand what's been going on with the economy and maybe prescribing a cure, for the markets and the economy and give us some insight. So, I've always said in the short run, the markets are very unpredictable, but in the long run, markets are pretty predictable. Every time we've had a recession, it's been followed by an economic expansion. Every time the markets have gone down, eventually they've climbed back up. And this too shall pass, and we don't see any reason why this is going to be any different. So sometimes we always hear, well, hey, Carrie, it's never been like this before. Yes, it has. I've seen it in the 70s. It's not unprecedented, and we'll get through this. So today, I'm delighted to have Dr. Quincy Krosby, again, who is LPL's Chief Equity Strategist. And today, Quincy's going to give us a little bit of a kitchen sink approach to what's been going on in the markets. And I say kitchen sink because now we're talking to Main Street, not Wall Street. And help us understand, Quincy, what's been going on, maybe what ails the economy, but more important, what might be the cure, and how long is this going to last? And certainly, we know predictions are very hard. So thank you and welcome, and thank you.
Thanks, Carrie. Yeah, thank you, Carrie. I really appreciate it. I talk about kitchen sink. I talk about kitchen table because I have a family. I've got friends who call me. They're not in our industry. And all they know is that, guess what? Their portfolios are not holding up. And my gosh, how can they retire? These are the calls that I get. And when we look at all this, I have to say, though, I'd say take 2 aspirin and turn on the Eagles. Take it easy. Then and don't look at your portfolio until this turns around. Just keep playing that. And you mentioned inflation. That song came out in May of 1972. You want to know what inflation is, folks? Go back to 70s and go back to the early 80s, man. It moved higher and higher and higher. So that's what the issue is right now. It's inflation. We know it. So if we go back to one of my all-time favorite downturns, which was the Lehman Brothers, remember that one? The subprime mortgages? Boy, that was evil. And why? Because we didn't know. It was like the game Old Maid, where look for the Old Maid card. Who had the subprime mortgages? Who had the leverage? They were betting 5 to 1, 20 to 1, 30 to 1, even 40 to 50 to 60 to 1 that the subprime mortgages will be okay, that folks would pay their mortgages. The whole thing unwound because folks started to play late and then stop paying it all. And it took a while to clean out the economy, to clean out the market. But we did. And I said to you when we had our initial call, I said, you try working on Wall Street. Wall Street's not a dirty word. We all come from different parts of the country. My husband and I served overseas. Guess what? 9/11, boy, you talk about uncertainty, man. Oh, that was like, what's going on? When's the market going to open? We got through that. We got through the tech bubble bursting. So let's look at this particular period we're going through. We know what caused this. That's the good news. We know what caused it. And what caused it was ironically, COVID, in the sense that the Federal Reserve came in and basically said, you know what? Things are going to fall apart. We just don't know what COVID is going to do to the economy. And they moved very, very quickly. The Fed actually has a balance sheet. We don't talk about it, but we've got balance sheets. You've got balance sheets. They've got one. So it's normally in this environment between $3 and $4 trillion. It moved to over $9 trillion as the Fed went out and just bought heaps of treasury bonds and mortgage-backed securities. They were worried that the housing market would fall apart, and everybody remembers 2008, 2009. The housing market just fell apart. It didn't matter what you own. It didn't matter what you wanted to sell. It was impossible. So they were worried, which is really ironic because the housing market did incredibly well during COVID, but they bought mortgage-backed securities. And the reason they bought treasury bonds, which is called quantitative easing, is basically so they could push interest rates down to zero. And because we factor in inflation, interest rates were actually negative. And why would they do that? They would do that so that the cost of capital, the cost on your credit cards, the cost for everything would be negligible so that we could handle it. No one knew whether there would be jobs. No one knew anything. Remember what it was like March 16th, 2 years ago. It was like, what world are we entering now? And so that helped. The other thing the Fed did, and I want to point this out, is they actually went directly into the market. They became what we call the buyer of last resort. It would be as if I said to everybody on this call, don't worry about it. If you need to raise money and you're a company, but you can't raise very much, I'll be the one to come in and buy it. I'll come in and I'll help you. We don't usually see central banks doing that, but the Federal Reserve did. They did it for the companies that we call high yield. That used to be known as junk. My favorite, because it was the first one up, was Kentucky Fried Chicken, because it's one of my favorites. And what we had was a situation in which they needed to go and borrow money. In order for them to do it in the market, they'd have to pay an awful lot in terms of what they would give the buyers of their bonds. By the Fed coming in and saying, don't worry, we're going to be coming in. If there's a problem, we will do it. And by the way, KFC was able to raise money more than they had expected at a lower rate, which is really very good. They opened the market. So that leads me to this. What happened, the fear was that liquidity would dry up in the market. Liquidity, folks, is equal to oxygen. You know, we can't manage without oxygen. The market can't manage without liquidity. When you hear people say on Fox Business, CNBC, we're worried about liquidity, it means they're worried that everything just gets so tight and clogged that you can't even sell something at a decent price, that money is not flowing the way it's supposed to. The Fed was very worried about that. And they did an incredible job coming in quickly and forcefully. And then you also had the White House. So whether it was President Trump or President Biden, it was just push money in to folks, put it into their accounts, you name it. The money just flowed out and out and out. And by the way, other central banks in Europe, they did that too. In England, they did that too, because everyone was terrified. How are people going to get through? No one knew what was going to happen. So all of this did what? It shoved lots and lots of money into the system. And during the downturn, where most of us were working from home, the cost for the market, so I get a little technical, what we would pay for big tech stocks, you know the names. I'll just mention them. I'm not saying to buy them or not buy them, but the Apple, the Microsoft, Amazon. Remember Peloton, right? We were all there. I wasn't exercising, but I was cleaning my house morning and night. That was my exercise. Those got to be expensive in market terms. We were paying more. And so why was that allowed to happen? And I think none other than the head of the Federal Reserve, Jerome Powell, answered the question in 2021. He had a press conference following a Federal Reserve meeting. And one of the reporters said to him, "Sir, I want to ask you something. You know, the market is very expensive." And again, that means we are paying up to buy stocks, particularly the big tech names, the ones we all know. And most of us love, actually. They keep the country and world going, but they were expensive to buy. And this was Chairman Powell's answer, because this gives us the clue as to where we are now. He answered this way. He said, you know, when you have interest rates at practically zero or negative, because if you factor in inflation, they're just like a negative, you can have a more expensive market because the cost of capital is negligible. People's credit cards, they're paying very much, and so on. He said, however, once rates go up, the market, by the way, has to pull back in terms of what we pay for the market. This is what's important. And then he added this, I will never forget it. He said, but don't worry, we're going to keep rates low for a really long time. So the market doesn't have to worry about that rates are going to go up and the market won't have to adjust quickly and dramatically. Well, okay, guess what? We saw inflation move higher and higher and higher. And initially, all we would hear is, don't worry about it. It's transitory. It'll go away. It's just part of adjusting to a world that's opening again, right? The world of post-COVID, so to speak. But then something else was happening at the same time. And that is what we call the supply chains. I am still waiting for appliances. They're supposedly made in America, big American names. I'm not getting anything fancy. I cook a lot, I bake a lot, and I hate to use the term, I won't even mention the names, but you know, they're fancy. And people are always bragging about their German this and their French that. No, I'm happy with the American brands, but they have Chinese parts. How about that? And so when I say, hey, guys, when is it going to show up? Quincy, don't worry about it. China may be opening and we'll get the parts. And meanwhile, I'm kind of desperate. I'm going to be hanging clothing outside on a string, like in the olden days. And I haven't cooked. Actually, I've gotten used to that. My husband says, are you going to be okay when you start cooking again and baking? I said, yeah, don't worry about it. But you see the problem. The supply chain got all caught up, untangled like this. And so part of it is China. They are having a horrible time opening. And one of the things about China is they have what's called a zero COVID policy, no COVID allowed. And one of the major centers in China, Shanghai, has about 25 million people. They are factories, industrial, financial hub of China, plus a very deep port. That port, if it worked, and normally is responsible for a global supply chain, things going to Europe, going to other parts of Asia, and coming to here at the United States, all closed. They were closed for 2 months, 25 million people stuck. It looked like a horror movie, by the way, when you look at it. And yet this is the Chinese policy. Now, Shanghai is about $7+ trillion of China's $17 trillion economy. That's how important it is. But it's important for us too in the world because we still depend on China. We're still part of that ecosystem where they manufacture things for us. So again, you think they're opening and then you find out they're not opening. You think that they killed COVID, then you find out now that they've got some COVID spots. And now the market is trying to wonder, oh my gosh, are they going to shut it down again? So that's also been a major issue to impede prices because when supplies come in on a regular basis, you know how much you're going to charge for it, right? And when supplies are scarce, you charge more. So this is the problem. We have our domestic inflation at home in the US, and we also have higher prices coming in from overseas. Here's the good news. All right, there is good news here. One, we had a report from the Federal Reserve in manufacturing. Now, you would say, Quincy, we're not a manufacturing country anymore. But you know what? We still have like 8 or 9% of the economy is manufacturing. And it's increasing. Believe it or not, I'm just throwing this out there. It's true. There's almost a manufacturing renaissance going on in this country. But the Empire Federal Reserve report is based on manufacturing in New York, New Jersey, and Connecticut. Not the hot spot of manufacturing, by the way, but when the reports come out, they lead. And then this week we'll get the Philadelphia Fed survey in manufacturing. This is why it was important, and there was good news when we got the Empire one. Shipments improved. They had more shipments. This is good news because this is what we are waiting for. We are waiting to hear from across the country as these reports come out. Are you getting more shipments? Because that indicates that the system is beginning to work, that the supply chain challenges are beginning to unwind just a bit. There is, if you follow the markets, you may click on once in a while to Bloomberg. Bloomberg has quite a few research units and indexes that they have created. And one of their major indexes that's followed widely is about the supply chain, and is starting to show it is easing. This is really good news, because the more that we could get, the better off it'll be, that we're not waiting. And then the guy says to me, well, you know, Quincy, when we finally get the parts, you know that your American-made, quote unquote, stove is going to cost you such, and it's like, and what are you going to do? You're kind of desperate. You have to pay for it. So this is good news. The more we see of this, the better it is. Freight prices are coming down. Shipping prices are coming down. This is all good news. And it is not because everyone thinks we're going into a deep, deep recession. No, it's because we're starting to see the lanes filling up. Even in our country, if you go out to California, where the ships are, down in the Oakland area, for example, LA, you're starting to see containers coming off that are sitting there. They're going back onto the boats. They're starting to move. And that is extremely good news. So I have to put that in there. Now, the other part of the story is the higher interest rates. And I need to go over this because it's not over. This is where the Federal Reserve has a mandate. Congress tells the Fed what your job is. They don't just make it up. They were told by Congress. One is price stability, making certain that prices don't get out of control. They remain stable. And the other is to have a full labor market. And so those are two mandates. And right now, the Fed is caught between a rock and a hard place, because what they want, and the only thing they can control, they can't control whether China shuts down Shanghai again. They can't control the freight prices. They can't control demand. And by design, they are slowing the economy down. You know what it's like? I have an air conditioner in the other room. It's a window unit, because the system here doesn't work. It's a window unit. You know what I notice? The electricity company slows it down when demand is high. They do. I know it because I keep a thermometer in there, and I could tell it should be colder, but it isn't. They're slowing down the economy, and they're doing it by design, because when that happens, our demand comes down and the prices are supposed to come down along with it. It is a kind of immutable in the economy that's what happens. Even in the housing market, at some point, it is going to happen that prices start to come down, despite the fact there was just a headline that New York City, a very tiny little apartment, is renting for $5,000 a month. Oh my goodness. But anyway, it will happen. It will happen that prices come down on their own, because mortgage rates are rising. And what are we hearing from the builders? Folks are canceling. They're canceling projects. They're canceling contracts, meaning that some of them are leaving money on the table because there's uncertainty. The Federal Reserve has created uncertainty about the job market. So I'll get to that, and I'll end up and turn it over to Carrie. They are raising rates, and they're doing it. We're calling it front loaded. They're doing it quickly. They're behind the curve. They were with this, oh, it's transitory. It'll be over soon. Well, it was not. By the time they finally decided to raise rates, we started to see inflation kind of everywhere getting into the system. And so they have given us a heavy dose of higher interest rates. And it is starting to work. We're starting to see the economy slow down. And now they're saying, look, we don't want to have stagflation where you got inflation, the economy is slow. We want to expunge inflation from the system. The chairman of the Federal Reserve says over and over again, you cannot have a solid labor market with price stability that doesn't exist. You can't have a good economy, the foundation of the labor market, unless we have price stability, meaning we know kind of where prices will be. We don't think, oh my gosh, they're going up, let's start hoarding. You know, right now I was hoarding during the pandemic. I could open up a kiosk of just toilet paper and Lysol when I could get my hands on it. And it's no joke. I don't even have closet space for it. I gave away a huge amount of it and I still have a ton. So anyway, that's what the Fed is doing. And I want to just tell you that next week, well, July 27th, the Fed is going to raise rates again. And they're front loading it, meaning get it out now as quickly as possible, while the labor market is still pretty solid. We saw retail sales. You know that we, the consumer, we are 70% of this economy. That's exactly right. The upper wage earners are responsible for more of the buying. Lower wage earners are not. And what we're seeing is pressure on the lower wage earner. They are worried about their rent. They're worried about food prices and at the filling station. There's no doubt about it. And they're using their credit cards. We could see from the data that we receive and what we hear from the banks, there's more pressure on them. But here's the fascinating part. All told, there's $2 trillion in the banking system for US consumers. A lot of that came from what the government gave us, but it tells you there's still a cushion. Corporate America, $1.9 trillion in cash, not counting financial companies like banks, for example. They've got a lot of cash. So that's where we are. The biggest concern right now, before I turn it over to Carrie, is does the Fed going in there and tightening just push us over the edge into a recession? And if they do, what kind of recession would it be? So that's what's important. We're in the midst of an earnings season right now, folks. We look back, so we're looking back the last 3 months, but so far, so good. Yeah, there have been problems. Of course there are. You know, look what everyone has had to deal with. The dollar is about as strong as it's been. It's risen 20%. We've only had 3 other times in memory where the dollar has moved this high, which means that our exports are under some pressure. And you've got a world economy that is under pressure because of their inflation problems. You've got this war. I could go on, but here's the deal. We're coming close to the midterm elections. Guess what? History dictates that, and it's statistical, so we could always be wrong, but history dictates that once we get to the election, regardless of who is in the White House, who's in Congress, and we're not just getting that vote out, that the economy, that the market has over the next 3 months after the election, a huge push up. And then when we do it on an annualized basis, meaning for the year, it could be about 14%. So I see this as happening by the time we get to the election. I think, or we think, I should say we, because I don't come up with these ideas. We work together in a committee. We think that the inflationary pressures will have eased. The supply chain challenges will have eased. And it will look as if the Fed is navigating us almost towards the end of their tightening. And that, I think, will be a catalyst to get the election statistics, at least to some degree, actually come out. In other words, you get pressure leading up to the election. You have the election, and then the market next 3 months after that the market just really wows us. We let me put it this way: we would not be surprised at all if history repeats itself. History doesn't necessarily repeat itself. It doesn't necessarily rhyme 100%, but we think we're going to have that end of the year rally. So this is very good news. Companies are not disappointing, by the way. Obviously, They have so much pressure, just like all of you, if you're small business owners, you're paying higher wages. The cost for everything has gone up, which means that what you get coming in, what we call revenue, is being eaten up by all of these input costs. That too will ease. So this is where we are. We're not Pollyanna, but we look for companies that are solid. We look for sectors that will do well. And we have moved our portfolios over to sectors that will manage to get through this difficult time. And I know that you work with your advisors, and they do a fantastic job working with you. This too shall pass. That I know. This too shall pass. If 2008, 2009 got us through, if 9/11 got us through, the tech bubble bursting got us through, and the Great Depression was over, this too shall pass, because we know what's causing it and we know what will pull us out.
So Quincy, it sounds like, really what causes is too much of a good thing.
Yes.
The government very concerned about COVID, the impact on businesses, people.
Yes.
Fill them with lots of money, keep interest rates low, get us through this uncertain period of time. And I guess maybe what they did is they let it go too long. And it would have been nice if, in hindsight, right, to take and raise rates a little bit sooner.
Yes.
But, one of the things people are always worried about is inflation actually causing this next recession. And, I think, gosh, as we come into this downturn, things really were too good. And the balance sheets of most Americans and companies, as you state, were very, very good. So even if we do have a recession, we might have already, been in it. We just haven't, classified it yet. Yeah. It's probably going to be a mild recession. And, what I see already is the Fed's hammer, higher interest rates, is already having an impact. In the last week, I spoke to a client that was selling their house. They got an offer from Open Door about a month and a half ago. The offer was at $610,000. This week it's at $550,000. Another client of mine is in the real estate business selling commercial property. Mm-hmm. Property was in escrow for like $7 million to build tilt-ups. Buyer comes in and says, sorry, cap rates are up. I'm not paying that much. And they actually negotiated the price from 7 down to like 5.2 or 5.5 million. Okay. So I think we're starting to, crest. And I think, maybe the worst is over. It seems like the data is starting to come in where inflation maybe peaked in July, or I should say this last time. Hopefully so, right?
Well, yeah. I mean, just to give you nobody likes seeing 9.1%. I mean, that was like the market had expected just below 9%. But when, get a big round number like that, it's like, whoa. Scary. However, quite a bit of that had to do with oil prices. So gasoline, actually, if you taken that same index and created it at the end of the month, you would have had a lower amount because gasoline prices started to come down. And come down mightily. Oil prices have started to come down. We know that the administration is, how do I say this? So keen, that's a good word, keen on getting oil prices down, that they have actually gone out and said, you guys come out, how about drilling? How about, President Biden puts himself at, how do I say, the counter to the parts of the party, the Democratic Party, that is like, hey, this is great because now more people will want electric. There's this tug of war within his administration, but he understands that if he doesn't get that gasoline price down, one of the things we know, Carrie, every focus group, you could be driving an electric vehicle every day. You pass the filling station, you see diesel, you see it. We know that whoever is in the White House is blamed. Even if it's not his fault, he is blamed, Democrat or Republican. And we also know that American consumers base their expectations on inflation very much on where the price of gasoline is going. It sounds odd, but we know that from their five-year expectations.
So yeah, definitely. And I think people have been kind of, we haven't had a pullback like this for a while. We haven't seen inflation for many. They've never seen it, right? Right? You'd have to be around in the 70s to see that. So Quincy, I got a couple quick questions that the audience is starting to send to us. Yeah. And the first one is, it's kind of, we'll see how you handle it. But anyway, She says, my stock investments have decreased almost to the original investment. Should I withdraw my funds before I have zero investment? So maybe she got started more recently, probably not a long-term investor. Yeah. But real quick, because I got a couple other questions. Okay. How would you answer that?
I would answer it this way. We live in a very fast world in the markets. It's fast. And the reason is 40 to 50 to 60% of daily market volume is an algorithm. It's not me or you or our traders. It's the artificial intelligence, okay, comes in, swoops in, and moves the market quickly. Things can change. And when they change quickly. And I can remember the Christmas Eve 2018. It was one of the worst days for the market. In December of 2018, the Fed was raising rates, trying to normalize rates. It was a nightmare, and I had to be in charge of Christmas Eve dinner. That's why I remember it. And it was like, oh my gosh, what am I going to do? People are screaming. They're calling Christmas dinner. Everyone's, Quincy, am I going to be able to retire? Should I sell? Should I sell when the market opens? This was Christmas Eve 2018. Now, supposing we all sold. Right when we got into 2019, at the first Friday, when the labor market report came out, this is what changed everything in a nanosecond. Chairman of the Federal Reserve, Jerome Powell, was speaking deliberately at a little press conference, and this is what he said before the market even opened. He said, the Fed is going to be patient, because the market had believed that they were going to be raising rates. They told us they were going to raise rates in 2019. That's code for we're not raising rates. And in fact, 2019, they lowered rates. Do you know what happened to the market? It took off. It was before the market opened. So we call that the futures market. Market opens at East Coast time, 9:30, and the market took off and never looked back. Did you really want to be out of the market? We could start seeing inflation coming down. There's a saying, Carrie, and you know it. The market gets the news first. Because what'll happen is you'll start to see the market sniffing out where we are headed. And it will probably happen, I think, where you'll get consumer staples start going into consumer discretionary, meaning things I don't need, but I want it anyway. They've been beaten down. The big tech names will start to get interest. Portfolio managers have billions of dollars sitting there in cash. They're not going to sit there forever. They're waiting for the news from the market, and it will go to work. So you can't time the market. Ask my husband. He one day said, I can't sleep. Get me out of this market. I said, are you sure? And he said, yeah, I'm sure. I just can't sleep, Quincy. Just do it. I said, okay, I'm going to make you sign a statement that you don't blame me for this.
He didn't have the P and the E, the patience, and he left his emotions. He had them with him. So yes. This question, the second half was, before I have zero investment. And I always tell people, you know what, the stuff that we're purchasing, if it goes to zero, we've got bigger problems, because there will be no government. There will be anarchy. Exactly. You'll be hoarding your food. We don't have that kind of a speculation in the portfolios. No. And the second question she was asking is, well, you know what? My daughter is a school teacher. She wants to start investing. Should I tell her to hold off? And I find that ironic, because, when is the very best time to buy stocks? When they're down, right?
Sir Mark Templeton, one of the greatest portfolio managers in the world. He was he created international investing. Mm-hmm. Sir John Templeton has a famous saying, and that is, you know it, you say it. You could say,
when is the best time to invest money? When you have it.
When you have it, and when there's blood in the street.
Right. Yeah. Yes. And so, for young people, this is a great opportunity, because they're able to buy stocks 19, 20, 25% cheaper than they were a little while ago. But you do have to have hope that mankind marches on, and that companies are going to thrive, and they're going to innovate and create products that you and I are going to want, and our families are going to want. And history tells us that's a pretty safe bet, right? As long as you have some patience and a little bit of optimism in your life.
Well, you saw the Eagles song, right? It came out. Don't get crazy. Yeah, it came out May 1972. When do you think Apple was created? It was created just about then. Look at Apple.
Steve Jobs' garage, right?
Yeah, exactly. This is one thing about our country, and we served overseas for our country. I was a U.S. diplomat working all over. I have to say, this country, it's in our DNA. We build companies, they get bigger, they get smaller, they merge, and so on. but the business acumen of the American spirit, in spite of Washington, not because of Washington, but in spite of whoever's there, it doesn't matter. We move ahead. And I look at people always say, Quincy, you lived all over. You want to invest here? Yeah, sometimes we'll put investments in from outside the US, but boy, can you do well investing right here at home.
Right. Yeah. So one more quick question is Ukraine. Ukraine probably is part of the process that's caused higher energy prices.
Yeah.
Maybe some policy that we've had in this country as far as, the ESG and, pipelines and things like that. So let's answer that question and then we'll just wrap it up.
Yeah, absolutely. Ukraine, the breadbasket, the breadbasket. Right now, the Russians, they had silos filled with grains when this war began, and they are gone. Everything is gone. President Zelensky said we're trying to plant again, but as is always the case, even if you live in a country where there was damage, water damage, you'll find some other part of the country that then picks it up. So we are beginning to see grain prices come down, wheat prices coming down. You're seeing other countries, Brazil, for example, taking advantage of the stronger dollar, because these are all commodities, coming in and coming in with exports. We Canadians are planting. The parts of the U.S. are planting, and it will come to fruition. In terms of oil, countries that you would never think of taking advantage of a market that needs oil, Angola, and making money because the dollar is so strong. So we're seeing all of that, and that's what happens. Alas, that's what happens. The market absorbs all of the bad news and it moves on, and it seems awful. It's heartbreaking to talk about it, but from the market perspective, the market looks ahead. It's the job of the market, and the market has no emotion. It's devoid of emotion. And sometimes I say it is a good thing. It has no empathy. It has no emotion. And that's good. We have the emotion, but the market doesn't.
Well, great. Thank you, Quincy. It's been awesome to have you here and you taking the time from, I think you're on the East Coast, to join us and share your thoughts and wisdom. Before you jump off, I think you probably know the answers to those polls. Well, let's see how people answered the questions.
I want to hear
on the polls.
Let me get my glasses on.
Okay. So 2022 Mid-Year Economic Outlook. The question is, as of July, what was the University of Michigan 5 to 10-year inflation expectation rate? Actually, the majority thought it was 5.1%, but the actual answer is 2.8. Yeah, so when they're looking ahead based on the data, they're actually projecting 2.8 at this point in time. And that's kind of what helped the markets, I think, in the last week or so. And, we asked people what was their biggest concern. We gave them, the market, the economy, the politics. Their biggest concern, 42%, is inflation. So that is why the Federal Reserve is so aggressive in using that big hammer of interest rates to try to bring that inflation rate down. Yes. Exactly.
Because think of this, your credit cards are now higher, the rates are higher, and you're also paying more. It's a double whammy, and especially a double whammy for lower income Americans. And the Federal Reserve, you may think they are not sensitive to who's earning what, but over the last 10 years, they have taken a tremendous interest in making sure that they just don't help rich Americans by making the stock market attractive, but also helping lower income folks. It's a shift that I've seen over the years. Whether it's good or bad, all I know is they know that they're hurting, but the hurt may come just a little bit more in order to get the inflation disease, out.
Right. Well, great. And hey, Bella, do you have any closing remarks or?
Yes, I do. All right. Well, thanks again, everyone, for joining us here today. And another big thank you to Dr. Quincy for taking the time to share with us today.
Yeah.
For everyone watching, you'll receive an email from us shortly with some short survey questions asking for your feedback. We make these webinars for you, and we would love to hear what you thought, how we can do better, all of those things. So we appreciate your feedback on those. Next, you'll be hearing from us once this recording is uploading to our website and also to our YouTube channel. So be on the lookout for an email with the replay of this as well. You're also welcome to share this with anyone, send that replay to anybody that you feel like this may encourage them or be helpful to them in the days we face today. Also, if we didn't get to
more importantly, we hope Quincy gets her appliances so she can start cooking.
Yes.
No,
Yes.
don't make me laugh because my husband would love to hear you say that.
Right.
He thinks I'm not telling the truth, that I'm telling the guys who own the store, just keep it. Sell it to someone. Okay,
you,
bye. Thank you so much. Thank you.
Of course. Also, if we didn't get to your question, go ahead and email us invest@kwbwealth.com and we'll make sure to get back to you. Be on the lookout for one more thing. Our next webinar is coming up it's September on business planning. So be on the lookout to register for that as well. Thanks for joining, everyone. Have a great day.
Thank you. Be good. Bye-bye.